and to now introduce Helen Wiley of SBP and Carolyn Kowski of EDF, who are going to talk about the themes that we'll be addressing in the conference.
Let me add to all the welcomes. We're so excited that all of you are here with us this morning. For those of you who don't know me, I'm Carolyn Kowski. I'm the Associate Vice President for Economics and Policy at the Environmental Defense Fund. And Helen and I are going to do a little tag teaming to kind of set the context and provide some of the motivation for why we're all here today. For us in particular, this workshop is really the culmination of several years of work struggling with this question of whether and how risk transfer tools can be used as a force for social good. And we didn't just think about that abstractly, but also grounded in place. And for us, that place was New York City. We were chosen in the inaugural cohort of the National Science Foundation Civic Innovation Challenge Awards to think about how to harness risk transfer tools to improve the financial resilience of lower income households struggling with ever worsening extreme rainfall related flood events. You'll hear more about that effort from some of my fantastic colleagues later today. Since the National Science Foundation and DHS through that grant is one of the generous sponsors of the workshop, as well as our other amazing sponsors you can see over here, for us in some sense, this is the culmination of that effort. But in other ways, this is really just the beginning. It's the beginning because we did a small learning pilot, and it was just the first step on a broader path that involves so many of you in the room about refinement, expansion, replication, and scaling of these efforts. It's also the beginning of new partnerships, as you heard in the collaboration between EDF and AU and SBP coming together for this event. And you're going to hear from lots of others over the course of the next 2 days who are also at the beginning of exciting new ideas and new projects and new approaches. And I, for one, am looking forward to hearing more about them. And of course, we hope that all of us just being here together will get new ideas going so that in the coming months and years, we'll have made some progress on these topics. Okay, I think the timing of us coming together is also maybe the right moment for an inflection point in how insurance markets, public policy, and climate change are interacting with each other. Insurance is now, of course, front page news. We all read the stories about insurers pulling out of markets, about people who go to rebuild and find they're uninsured or they don't get the payment they thought they were owed and are left struggling. I've been thinking about disaster insurance for over a decade and a half, and I think there's a couple things we can take at this moment that I think you'll agree with. The first is that disaster insurance, in particular, is more important than ever. We now have a growing body of research that demonstrates that when households have insurance, they have fewer unmet needs, they rebuild faster, they have lower financial burdens. And as more people in a community are insured, local economic activity can resume faster. We also know from this research that without insurance, people can spiral into greater levels of financial precarity, and that lack of insurance can be a driver of ever-widening inequality post-disaster, as those with insurance rebuild, get back on their feet, maybe upgrade their home, and those without insurance struggle to make ends meet, maybe fall behind on their bills and other payments, and have to live in damaged homes as months stretch into years with very little help forthcoming. The ability of insurance to provide these benefits is, of course, because, let's face it, our other options to fund recovery are quite limited, and we'll hear more about some of that today. As we now face climate extremes, the likes of which we've never experienced before, the importance of insurance grows. And not just disasters that are like the past, but heat waves that are not a bit hotter or a bit longer than normal, but like the Pacific heat dome in 2021, exceed all previous temperature records by more than 5 degrees. It's not just on land, it's in our oceans too, with the unprecedented marine heat waves having destroyed coral ecosystems in Florida, and that heat is dangerous fuel for hurricanes which are intensifying faster and showing up in places we're not used to, like California, or wildfires, which are also burning in surprising places like Louisiana, as well as the infernos we've seen unleashed in California, Canada, and of course, Maui. So back to the first thing. In the face of this growing risk, insurance is more important, which brings us to the second thing. All those changing extremes are making insurance harder to provide and more expensive at the moment we need it most. Insurers can no longer profitably offer coverage in some of the highest risk areas. They pull back, raise their rates. There's anecdotal evidence that they're also reducing coverage with more sublimits, higher deductibles, and climate disasters impose a range of non-property losses as well that our current system is not well set up to address. At this moment, there are certainly other pressures in insurance markets. The higher cost of rebuilding is one, higher interest rates, legal challenges in some places. There's always state regulatory dynamics. The reinsurance market is feeling some of these same pressures. That gets passed down. On the other hand, that's how climate change operates in conjunction with other stresses. And I really believe that at base of these challenges is fundamentally higher risk levels. And in the places where those risks are highest, it's broken our current system of insurance. So to steal a line from my amazing colleague Kate Stillwell, who's with us today, how do we unbreak our insurance systems? Unbreaking them is going to have to require better links to actual reductions in risk, because when you violate mathematical principles of risk pooling with ever higher correlations and fatter tails, moving risk around might not cut it anymore. We also can't unbreak the system only for the wealthy few. We have to unbreak it for everyone. So that's our charge today, and we hope everyone in this room is going to figure it out at the end of the next 2 days. Before I turn it over to Helen to give us a little bit more background on our themes and our charge here, I want to just raise 3 questions and topics that I think are going to continue to emerge as we navigate these challenges. The first is the role of government. We're now seeing trends of risk first being pushed down the chain. So reinsurers are covering less of the risk of climate catastrophes or driving up their prices. So primary insurers are forced to hold more. They pass that on to households by pulling out or putting in coverage restrictions or charging a lot more so people can't afford it. And as that happens, risk is then transferred from the private sector into the public sector. We see growing number of policies in our state residual market mechanisms, whether that's Florida Citizens, Louisiana Citizens, the California FAIR Plan. We've also seen households go without coverage, whether it's the declining numbers of households with flood insurance or the reporting lately that households often now are dropping homeowners insurance when they've paid off their loan because it's simply unaffordable. Given the pace of climate impacts, it's starting to feel, to me at least, a bit inevitable that the government is going to keep playing a larger role in covering the risk of climate extremes, even if there are some places and some markets where there are changes we can make to bring back more private coverage, and we absolutely should make those changes. But if we let the public sector assumption of risk continue in an ad hoc way without being thoughtful about what it means or how it's structured, I really think it's going to be too bad, because we will have missed opportunities like predicating the socialization of risk that's now happening on serious investments in risk reduction and in elevating the importance of inclusive access to insurance as a necessary social good. And if we allow the shifting of risk to continue without the right policy frameworks, we also raise the odds that we strain our public sector programs to the fiscal breaking point. And if we do that, that will have even deeper ramifications for housing markets, local economies, and people's well-being. So let's be careful about that public assumption of risk. Related to this question of how to improve the amount of risk transfer is how to get more people to invest preemptively in risk reduction. If our late colleague Howard Kunruther were with us today, he would be stressing how difficult it is to convince people to invest in reducing risk when the sky is blue and they have a million other priorities. We know people are overly optimistic. We know insurance is no fun to buy, except for a few of you in the room who might enjoy your insurance purchases. But we also know how much prevention and preparedness matters. Perhaps the growing tempo of disasters will motivate more dramatic investments in risk reduction, and we do have more federal dollars now to support those efforts. And the thing is, as you'll hopefully hear tomorrow from Roy Wright, the person best to speak on these topics, is we know how to do this. And I think there's lots of opportunities for insurance to play a larger role in supporting that effort. You'll hopefully hear some great examples of projects underway today, but we also need to do a better job of harnessing the rebuilding process to build back better and stronger, or sometimes not at all. And right now, we don't have the institutional frameworks or the financial ones to make that easy for people after a disaster. And in the chaos and trauma of a post-disaster situation, if it's not easy for people, it won't happen. To do that, we need to ground our work, this brings me to my last and third topic, in risk and climate impact assessments. We know there's been an explosion of data and analytics to help this, but we also know that more information does not always translate directly into better decisions. especially when it's not accessible, which can be especially true for households, small businesses, and local governments, because we're not necessarily injecting that information at the moment it's needed. Or we might be intentionally withholding material information from markets with the belief that we have to do so in order to protect privacy or to stabilize housing values. But what that does is just push the day of reckoning off and impose costs on people unaware and can unintentionally trap people in risky situations. If you think about a household moving into a new location, we know now there's lots of places they can go online to look up risk information, which is a huge improvement, and the groups like the First Street Foundation are trying to bring that into housing listings so that it's available early in the search process. But we also know lots of important information is still missing. Households can't easily look up the full cost of flood insurance, for example, even though that could be a better indicator of risk than FEMA maps, even though it's financially important for their decision about whether they can afford to live somewhere and need it early in their housing search process, and even though it's a public sector program with some public dollars and one price per property set by FEMA. Households are also not told critical information, like is this property one loss away from being repetitive loss, which is good information on the risk and the cost of living there. And we certainly don't have anyone telling people, hey, this is your insurance premium today, but you live in an area of growing climate risk, which means your premium is going to be going up year on year into the future. We also are failing to inject risk information into the initial building decisions. When a permit is issued, do we require an assessment of climate risk over the life of that investment and the cost of insurance for the future occupants? And we need to pay attention to democratization of data. There's lots of fantastic data and modeling out there if you can afford to pay for it, and the institutions that can absolutely can and should and need to. But we also have to make that information available to under-resourced households, communities, and SMEs, because it's important for their decision-making too, and markets only work well if there's full information. And I think we need to do more as a risk community, and I include many of you in the room in that broad group, to help make users of this information better consumers of it. Which models are fit for their decision-making purpose? What are the assumptions in this model? Are they the right ones for the decisions I need to make? Okay, I will end now and turn it over to Helen, but I want to make one final point that I think needs to be said. We're not going to be talking about it much today, but the ultimate risk reduction for climate-related disasters is lowering our emissions. And the faster we make progress on decarbonization, the more we can stem these growing risks. And I think there's room for insurance leadership on that side of the climate coin too, and I know there's some of you in the room that are doing some really excellent work on that I want to just call out. So with that, let me turn it over to Helen for some more background on our charge today. And I'm looking forward to our time together.
Okay, thank you, Carolyn, for your remarks, and thank you again to EDF and American for your partnership on this conference, as well as our corporate sponsors. My name is Helen Wiley. I'm the Disaster Preparedness Program Director at SBP, which is a national nonprofit organization that exists to shrink the time between disasters and recovery. In addition to rebuilding homes for low-income disaster survivors to higher resiliency standards, our organization aims to prevent as much suffering as possible by preparing and advising communities and advocating for more effective federal policies. I'm joined here today by several of my colleagues, including Zach Rosenberg, who founded SBP after Hurricane Katrina down in St. Bernard Parish 2 decades ago. Today and tomorrow, we're gathered at this conference to share insurance innovations and solutions to help address some of our pressing disaster challenges. As such, we have 3 interrelated themes. The first is improving equity in disaster recovery. If people cannot access financial resources, their recovery will be much slower and they will sustain further hardships, as we see time and time again, unfortunately, in the most vulnerable communities across the United States. As Carolyn shared, we know that disaster insurance is the best financial tool for a speedy and fuller recovery, but too many families cannot afford insurance or do not understand the risks. According to the Insurance Information Institute, only about 4% of homeowners nationwide have flood insurance, and although 90% of catastrophes in the US involve flooding. The percentage is even lower among renters who are disproportionately vulnerable. Notably, when myself or colleagues lead preparedness trainings, all too often participants do not know that flooding is excluded from most homeowners insurance policies. Looking at our own SBP data, 67% roughly of clients have neither homeowners nor flood insurance, despite living in some of the most vulnerable disaster risk-prone communities of the country. What do disaster survivors do when they don't have insurance? Well, many families, as we know, rely on federal disaster assistance. The reality, though, is that federal assistance is limited and not guaranteed. The average federal disaster individual assistance grant is only about $5,000, while the average flood insurance payout from the National Flood Insurance Program is about $70,000. Disaster assistance is therefore no substitute for insurance coverage. And for our most vulnerable households, accessing aid is extremely challenging. Additionally, too many households do not realize that they will not be able to access federal aid more than once unless they maintain insurance coverage for a like event. With no savings, limited access to credit, and both insufficient and delayed aid, the most vulnerable households take years or decades to recover from events. One of our SBP rebuild clients recently shared that she had moved 21 times since Hurricane Harvey hit Houston in 2017. With delayed and limited access to resources, our most vulnerable families often spiral further downwards financially, sustaining further hardship and costs in their long road to recovery. In this conference, we will discuss options to address inequity through solutions like means-tested insurance and promising microinsurance models that could help more low-income families to access resources quickly after disaster events. Our second theme is linking insurance to risk reduction. Mitigation and insurance must go hand in hand to not only reduce risks, but provide households with needed financial protections. By taking steps to address increasing risks, we can achieve layers of protections for those who would experience outsized impacts by such disasters. Transitioning homes from being uninsurable to insurable is not only important for individual households and communities, but for making the market sustainable long-term by increasing the consumer pool. While risk reduction is one of the best ways to bring down costs, there are several unaddressed questions. For example, do communities know what type of investments insurers would value most? And are there ways to bring insurers into important local conversations about land use and development? In turn, how can we ensure that CAT models incorporate more forms of risk reduction, including those like nature-based solutions, which have been harder to quantify? If we can ensure a more formal link between insurance and mitigation, households and communities will see more returns on their investments through reduced premiums and increased coverage options. Action here is critical, and we'll explore some big ideas during this conference. Our third and final theme is stabilizing insurance markets. A recent report found that 90% of U.S. counties have experienced a natural disaster serious enough to receive a disaster declaration in the past 10 years. In 2023 alone, the U.S. has already experienced $23 billion disasters. That is a new record for this point in a given year. While climate change spurs increased disaster risks, as well as continued development in high-risk areas, our disaster losses are projected to continue growing. Areas of the country, as we know and Carolyn described, are becoming uninsurable with insurers pulling back. Additionally, rates are increasing to reflect these increased risks, which is further spurring households to drop their policies and narrowing the market pool. States most at the forefront of this crisis, including Florida, Louisiana, and California, have seen an increasing number of bankruptcies. Since 2020, at least 8 Louisiana homeowner insurers have already become insolvent, and dozens others have submitted withdrawal notices to Louisiana's Department of Insurance. Finding new ways to expand the consumer pool is critical for stabilizing the market long term. Our three interrelated conference themes make clear that we desperately need new solutions to address our pressing challenges at hand. In the past few years, there have been a whole range of solutions and ideas being introduced by private and public sector stakeholders. It's really been a pleasure working with Carolyn and other partners to learn and experiment with what types of new products and programs could be used. As we unpack solutions that span across these conference themes, our hope is for conference participants to share lessons learned from pilots so that other communities can test, replicate, and scale similar models. Noting, of course, that there's no one-size-fits-all solution, but many complementary measures that can be taken. By sharing lessons learned and trading ideas, we hope to build a larger community of practice for making insurance a tool for social good. By building a cross-sectoral group of stakeholders, not typically in conversation with one another, we hope to see more insurance innovation launched in the months and years to come. In disaster preparedness and long-term resilience building conversations, insurance is all too often left out of the discussion. It is a tough nut to crack, as we know. Not only do we need to unbreak the insurance system, as Carolyn stated, but we need to unbreak the entire disaster system. Insurance is one critical layer of building more resilient communities, and we cannot seek to create solutions in silos. In summary, we hope that the bold ideas and innovations offered in this conference will inspire more cross-sector collaborations and advance us towards grounded solutions that aid our most vulnerable communities amid increasing climate risks.